Okay, here's the Caradogs for today. You miss Wall Street earnings estimates by nearly 80%, and the market just completely shrugs it off. Welcome to Earnings Unscripted, where we try to figure out how that's even mathematically possible. It's August 13th, 2026, and we're looking at Brookfield's second quarter under ticker BN.
Yeah, that miss looked brutal on paper. They only printed 14 cents a share, and the street was looking for something closer to 65. But you've got to remember, traditional net income for a massive asset manager like Brookfield is practically fiction.
Right, because their accounting is weighed down by depreciation on all those heavy physical assets. But their actual business activity held up fine, didn't it?
Better than fine. Revenue came in around $19.4 billion, but the real heartbeat for them is distributable earnings, the actual cash they can spend. That metric grew roughly 15% year over year. That's exactly why investors looked past the headline miss.
Which totally tracks with the wild trading today. The stock spiked pre-market, dumped all morning during the actual earnings call, and then steadily clawed its way back into the green by the closing bell. And since we're decoding market psychology today, I should add that all our theories are purely our own opinions, not formal financial advice.
The classic algorithmic panic followed by human buyers reading the actual transcript. Once you see the underlying cash generation, you realize they're positioning themselves brilliantly.
Seriously, I mean, they're touching everything right now. I was reading about that massive Kentucky AI gigafactory they're doing. They're pivoting from just building the concrete walls for data centers to literally financing the Nvidia chips inside them.
Exactly. Half the cost of these new facilities is just the GPUs. So they aren't just acting as a real estate landlord anymore. They're moving up the tech stack. But honestly, the part of the quarter that actually kept me up last night wasn't the glamorous AI stuff.
Okay. Color me curious. If it wasn't the AI factories, what's hiding in the filings? Is this about that weird discrepancy in how they calculate the wealth solution spread?
Yeah, it's definitely related. Look, the whole spread discrepancy is a symptom of how they structure their entire balance sheet. Competitors usually run pure fixed income portfolios, right?
Right, mostly bonds. Super predictable, but lower yield.
Exactly. So when Wealth Solutions reports a gross spread, they had one around 2.24% this quarter, analysts struggle to compare it fairly. To get an apples-to-apples view, you've got to adjust for the total returns of the underlying equity holdings in Brookfield's broader portfolio. Once you do that, the real adjusted spread lands somewhere closer to roughly 220 basis points.
Okay, because they aren't just buying short-term paper, they're funneling this premium capital into their massive alternative asset machine. But wait, I'm stuck on something basic here. Because they just swallowed the Just Group to aggressively scale up their pension risk transfers, right?
Right, that was the big move.
But aren't corporate pensions basically the exact same product as a standard retail annuity? From an insurer's perspective, it's just incoming capital you hold and pay out slowly over time. Why this massive, sudden obsession with pensions?
There aren't the same at all, and that's actually the core of their entire long-term strategy. With a retail annuity, you've got a single consumer on the other end of the contract. Consumers panic. If rates jump or they lose a job, they might take the penalty and cash out early. That's called lapse risk.
Oh, okay. So the capital isn't permanently locked. It can literally just run away if the market gets weird.
Right. But a corporate pension, once a company discharges that liability over to Brookfield, there's no consumer choice involved anymore. The beneficiary timeline stays completely locked. Sachin Shah actually laid this out perfectly on the earnings call. I have the exact phrasing here. He said, if you think about pensions, they are different than annuities. There is no lapse risk in a pension. So when you offer a pension to someone who is retired, you are paying them really until mortality.
Wow, until mortality. That's such a beautifully morbid Wall Street way to say for the rest of their natural life.
It's incredibly dry, but it's structurally perfect. Think about it, Susie. Brookfield builds 30-year physical assets. Toll roads, power grids, these AI facilities we talked about. You can't liquidate a wind farm on a random Tuesday just because a bunch of retirees suddenly decided to cash out their annuities for a cruise.
So the pension capital is the ultimate matching puzzle piece. It doesn't flinch. It doesn't lapse. That's honestly brilliant.
It's the playbook. But, and here's the catch, scaling this operation up isn't free. On the call, management noted the Just Group's internal cost structure runs roughly 2 to 3 times what some competitors pay when bidding for these pension products.
That's a chunky premium just to get your hands on the capital. They've got to be planning to gut those operations, right?
Completely. They're hoping operational cost cutting will eventually squeeze out maybe another 50 basis points in spread expansion. But for now, they're eating a huge upfront penalty purely to secure that long-term duration match.
It makes sense, though it feels like a tricky integration if you've got to aggressively gut costs while simultaneously shifting massive assets internally. Didn't they just move roughly $1 billion of economic interest from their main corporate parent over to the wealth solutions arm?
Yep. It was a massive stake in their business services unit. The move keeps the capital efficiently within the Brookfield universe, but it definitely introduces some interesting complexity. You're basically cross-seeding capital across your own distinct subsidiaries.
It's like moving money from your left pocket to your right pocket to show proof of funds. If the valuations on those internal holdings ever drop, doesn't that circular financing suddenly become a massive systemic headache for their balance sheet?
It absolutely does. If those underlying asset values drop, the internal leverage starts working against you, but they've built this structure to endure exactly that kind of stress. That's why they want those locked-in pension liabilities we talked about earlier.
Right, because having long-duration capital means they never actually have to sell when the market panics. They just wait it out.
Exactly, and they're playing a very long game here. The corporate simplification they just approved, essentially merging the parent corporation and the wealth arm, it's not just some accounting exercise.
Right. I almost forgot about that piece. Because management admitted the old structure kept them out of major stock indices, didn't they? So this whole reorganization is just setting the board up for automatic buy flows.
Huge mechanical buy flows. Nick Goodman was pretty blunt on the call. I have his quote right here. He said, under our current structure, we had zero path to U.S. index inclusion. I would say now, being in domicile of convenience and with the fact pattern around our business, we have the option.
Which perfectly aligns with what Sakshan Shah was saying about their ambition for the wealth division, because they reaffirmed a target to reach more than $300 billion of insurance assets by the end of the decade.
Yeah, and they're going after the broader U.S. fixed annuity market to get there. The goal is to push deeper into broker networks to scale up without necessarily growing at all costs.
$300 billion. Just a casual target for the weekend. But honestly, watching them shift from pouring concrete for data centers to financing the AI chips inside them, and now hoovering up corporate mortality risk, they're building an entirely closed loop.
It's entropy with better marketing, but as long as they stay patient with monetizing those assets, the machine just keeps running.
It's really a fascinating machine to watch. I think that covers the big questions for this quarter. Thanks for braving the filings with me today, Myro.
Always a pleasure. Catch you later.
If digging into these numbers fits your routine, consider keeping us in your weekly podcast lineup. Just to be totally transparent, this entire show, including our synthetic voices and the written script, is an AI-generated experiment designed to compress Brookfield's massive quarterly filings into your feed the exact same day. We'd really love to hear what ticker you want us to unpack next, so send a quick message over to earningsunscripted@datamadness.ca.